This content is for educational and entertainment purposes only. It does not constitute investment advice.
Literally everyone says, buy the dip. Cool, but which dip? It's one of the most repeated phrases in trading. Some say they wait for RSI to go oversold. Others swear by the 0.618 retracement. And one person even told me they just feel it. And that's what it hit me. If buying the dip is such a simple, proven idea, why does everyone have to do it differently? And more importantly, why do so many of those dips fail? If buying the dip was really that easy, then there had to be some kind of golden rule, something anyone could follow to trade pullbacks with confidence. So I decided to test it for myself, to go rule by rule, indicator by indicator, and figure out if any of them could hold up across different market conditions. And the first strategy I tested was definitely one you've heard of before. Buy when RSI goes oversold. Simple enough. And to be fair, this strategy was capable of finding some phenomenal entries. I mean, take a look at these two trades here. Clean bounce, perfect timing, nice little profit, exactly what you'd hope for a dip buying strategy. But then I kept testing and I realized there's one massive issue with this strategy. When price is selling off, I mean really dropping hard, this strategy completely falls apart. You see, RSI will cross under oversold and price will just continue falling. And even if there is a small pullback, it's not usually enough to justify buying the dip. I looked at a ton of other examples, and even though there's no doubt that the RSI dip buying strategy can truly find some great trades, most of the time it just felt like pure chance. And as tempting as these RSI dips looked, they just weren't consistent. Beautiful in theory, but not something I could actually rely on. And here's the full-fledged backtest for the RSI dip buying strategy that shows just how much I struggled to find anything consistent with this rule.
But that's not the only strategy I tested.
Next up is Fibonacci, probably the most cited rule for dip buying. Wait for price to pull back to the 618 and, well, load up. So I tested a strategy that did exactly that. Simple rules. Buy when price hits the 618 retracement and exit either when a move back to the high occurs or if the dip keeps dipping back to the low. And then just flip this strategy upside down for short trades. Now, to be fair, this strategy actually had some incredible trades in a few spots, and the profit targets were almost always way bigger than what was achievable with the RSI strategy. But there was one big problem I kept running into with this strategy. It was almost impossible to consistently pick the right highs and the right low to draw my Fibonacci levels from. Because let's be honest, there are tops and bottoms all over the chart. And sure, you can always find a swing high and a swing low after the move happens and say, look, the 618 held perfectly. But choosing these points in real time before the move actually plays out is a whole different story. And even though I was able to find some good opportunities with this strategy and there were periods of consistency, I just wasn't able to avoid having a really large drawdown when I didn't pick the right highs and the right lows to draw my Fibonacci levels. And next, I tested one of the most common strategies in trading. Buy the dip when price crosses below the 50-period EMA. Simple enough, wait for price to dip under the EMA and then look for a long entry. And in some cases, it really did work. Price dips just below the line, buyers step in, and you catch a pretty nice bounce. But the more I tested this strategy, I quickly realized that it takes way too many trades. And sometimes price respected the EMA beautifully, but other times it just sliced right through it like it wasn't even there. And here's the poor issue I ran into. The EMA didn't tell me whether the dip has actually stopped. It's just a line. There's no signal, no conviction, no pressure, just price touching a moving average. In the right conditions, it's clean, but as a standalone dip strategy, it was way too inconsistent for me to trust test and took way too many trades. And let me tell you, I tested everything: MACD, stochastics, supply and demand zones, volume-based strategies, but I just couldn't find anything as universally powerful or as persistent as the mantra buy the dip. And that's when it hit me. Maybe I was going about this completely wrong. Maybe the answer wasn't a single indicator, but a more nuanced setup, a combination of logic, intuition, and my years of trading experience. A multi-layered strategy that blended structure, context, and was more disciplined than guessing, but more flexible than a rigid signal. So I gave up trying to find the one rule that works and started asking myself a better question. What do the dips that actually work have in common? I went back and studied every clean pullback I could find in trends, consolidation,
breakouts,
you name it. And what I found wasn't one magic trigger. It was a cluster of conditions. You see, the best dips didn't just look oversold. They came in the right place at the right time, in the right kind of trend. And once I saw that pattern, I couldn't unsee it. It wasn't just about the entry candle anymore. It was about the environment around it. And that's when I stopped thinking in single signals and started thinking in layers. A strategy that doesn't react to one thing, but waits for several things to align. Now, rule number 1, price must be trading above the 500 bar average range. First, I need price to be strong, stronger than most of its recent history. So I use the average of the highest high and the lowest low over the last 500 bars. You can think of this as a long-term range filter. If price isn't trading above that midpoint, I don't touch it. And this will helps me figure out if the market is bouncing from weakness or if it's actually dipping within strength, which is exactly what I want. Now, rule number 2 is that the trend must still be intact. So I want the trend to still be active, and that means that super trend has to be green or positive. If the trend is flipped bearish, I don't want to be the one that's catching the knife. But if it's still bullish, that's when I know the dip might just be a pullback, not a reversal. Third, structure. I want the most recent swing high to be higher than the one right before it. No higher highs, no trade. That's simple. This condition tells me that the market is still building upward momentum and that any sort of pullback is happening within an uptrend and not after it. And finally, the flush. I want a 2-bar RSI to dip below a threshold, usually under 10, because this condition shows me that the market just hit a short-term oversold extreme. I don't really want to enter on a calm pullback. I want pressure, people getting shaken out right before the trend continues. And once all of these conditions were met, this would satisfy my personal buy the dip strategy. Quick heads up, I'm about to show some backtest results. These are simulated based on historical data and meant for educational purposes only. These backtests are not financial advice, and past performance doesn't guarantee a positive performance going forward. I'll walk you through what I tested, but definitely do your own research before using any strategy. Now, I know what you're probably thinking. There's no way I can keep track of all 4 of those conditions in real time for all the assets that I trade. And yeah, I have the same thought. So I told my developer, look, I really want to test this setup, but it's too much for me to do manually, let alone anyone, and within minutes, he built a tool that does it all automatically. And the first thing I did was point this strategy at Bitcoin, and in the tests I ran on historical data, I was honestly surprised at how clean the setups looked. But I also noticed something important. The strategy didn't perform equally well everywhere. Different markets, different time frames. Some looked great and others just didn't. That's the reality with any rule set. And just a reminder, these are back tests, so take everything with a grain of salt. So at this point, I had something I was really excited to use, a clean 4-rule strategy. But the deeper I went, the more I saw how performance varied. Some assets did well, but on other time frames, not so much. That's when I had the thought, what if this strategy could adapt? What if they didn't rely on static inputs, but could actually learn from the data and self-optimize? So I went back to my developer and I asked him for a version of this tool that could stay consistent across market condition, timeframes, and volatility regimes. Because as we know, all markets move differently and all markets dip differently. And that's what my developer handed me, Razer IQ. Just a quick heads up, Razer IQ is a trading view indicator that unlocks when you register with our affiliate exchange. It comes at no extra cost to you, but if you sign up and place trades, we may earn a small commission. But trading is not necessary to unlock Razer IQ. Razer IQ takes the 4-rule setup we just discussed and automatically self-optimizes the parameters behind those rules. And the best part is that Razer IQ turns those 4 rules into a single neon green line on the chart. This neon green line is the exact price level that must be hit for all 4 conditions to be true and for Razer IQ to take a simulated, hypothetical, long position. Green upwards triangles on the chart show hypothetical long trades by Razer IQ, and red downwards triangles on the chart show hypothetical short trades taken by Razer IQ. And anytime you see a blue triangle on the chart, this just means that a trade was exited. So if price comes down and closes beneath this neon green line, then Razer IQ will initiate the simulated long position. Additionally, Razer IQ will show the profit target and stop loss it's going to use for each trade. And for this historical hypothetical position, Razer IQ used a reward risk ratio of 1.73. Just for context, I've been personally testing Razer IQ on the 45-minute Bitcoin chart. And what I'm showing you here is a simulated backtest, not live trading and not financial advice. Just for context, I've been personally testing Razer IQ on the 45-minute Bitcoin chart. And what I'm showing you here is a simulated backtest, not live trading and not financial advice. I've also been testing Razer IQ on the 30-minute, 1-hour, and 2-hour charts, not just on crypto, but on stocks like Apple, Microsoft, and other names in big tech. Now you're probably wondering, if this indicator does everything he's saying, how hard is it to set up? And that's the best part. Razer IQ only has 6 settings. Limit order stop loss, which is for longs only. So if you enable this setting, then Razer IQ will use a traditional stop loss, a trade long or trade short option, as well as a minimum ATR profit target and stop loss setting. But this only affects shorts, not longs. The rest of the settings are purely for visuals and don't affect the actual output of this indicator. Now, Razer IQ comes as 2 indicators, the traditional indicator itself and the backtester. And there is an important method that you have to follow to set up the Razer IQ backtester correctly, but it's super simple. Check out this box over here with the long strategy number and the short strategy number. You can see my long strategy number for the backtester is 101 and my short strategy number for the backtester is 250. Now to correctly set up the Razer IQ backtester, I just have to go in the settings, find the long strategy number option, and then change it to 101, which is what I see in the text box here. For the short strategy number, all I have to do is change this value to 250, which is exactly what I see in the strategy performance table here. Once this option is complete, the warning table will go away at the bottom and I can pull up my hypothetical performance test and do more research on this strategy. And just a quick note, if you have Razer IQ on the chart and you don't see any neon green or neon red lines, this just means that one of the 4 conditions that we went over earlier are not currently satisfied and Razer IQ doesn't have an opportunity to enter a trade based on its algorithmic logic. And of course, you can even set alerts alerts on Razer IQ for any of the strategy actions that it takes, so you're always in sync with Razer IQ's analysis. Like, drop a comment, and subscribe with notifications on so you don't miss what's coming next. You can also follow us on Twitter and TradingView. Links are in the description, and I can't wait to see you in the next video.